My name is Blaine Anderson. I'm a certified financial planner and professional at Bander Wealth Management. I would like to share with you a case study and something that we're working on right now as an active case. We, as tax smart wealth advisors, will often work alongside your tax professionals and seek to provide tax and investment strategies. We know the power of combining these two strategies, and we all know it's not what you earn, it's what you keep. Therefore, I'd like to share with you a current case study. Perhaps there's some things you can extrapolate to your own personal situation that might be helpful to you. It's important for me to mention that each of the individual investments should be considered separately and a private prospectus memorandum reviewed at the same time of a consideration. I will share with you a high-level overview of some things that we are considering for a high-income earner who also has some capital gains this year. We're looking to apply tax and investment strategies. This particular client has W-2 income, but also has 1099 income. So part of the strategy is to have an LLC set up and begin to get some tax deductions through the business. I'm going to share my screen and walk you through a few details and things that we consider as tax smart wealth advisors. I, of course, will omit any personal information related to this client, but I want to share with you some of the numbers. This particular client is based out of Arizona and is in a 37% marginal tax bracket. What we've done is look at a few different strategies and then ultimately trying to reduce their taxable income by $817,000, which in a 37% marginal tax bracket equates to a $302,000 tax savings for this year. Allow me to explain a couple of the considerations. First, as mentioned, this client has an LLC. So we're going to set up what's called a defined benefit plan. Essentially, this is a 401k or a tax deduction plan, tax deferred plan that we can accelerate contributions into based on the defined benefit. So it has a lot of similarities to a term often known by many as a pension. Because of this particular plan, we have an annual compensation of $275,000 through this LLC. By making a defined benefit contribution of $126,000, which this client is eligible, we're able to reduce their taxable income by that amount. We're also able to set up a 401k that allows for $23,000 of contribution plus an employer match. So what that does is allow another $39,500 to be contributed. Now, oftentimes we will send information about this defined benefit plan to investors. It's great for businesses that have high income, few employees. Often you'll see this in dental practices, family businesses, law firms, property management, or real estate entities. This particular client has a consulting business and receives income for consultation services. This particular structure or one-page explanation gives a few examples of a medical practice with 1 to 10 employees where the doctor is 53 years old, and you can see with a $280,000 compensation can contribute as much as $210,000 based on this scenario and their employees. The one that we're seeking to apply right now is the married business owners with 3 employees. And we're actually even looking at adding the client's spouse and children as those employees. But what this does is allow large contributions that are tax deferred and also provide a tax deduction. That's one thing. The second thing is we're looking at adding some of the client's children to payroll. What this does is help reduce the taxable income to the business and move from a 37% tax bracket to the children's lower tax bracket. And actually, there's even a strategy for that income when it's at this level, $12,000, that not requiring a tax return or taxable income to be reported by the children. I'm happy to send to you greater details on this strategy, but what it does is reduce the taxable income to the client at the 37% bracket and reduce it significantly in going to the children's tax bracket. Also, for this client, though, what it does is make the children eligible to even contribute $7,000 to their Roth IRAs. We view this as a long-term estate planning strategy and a great way to get your children started in thinking about long-term investing and doing it in a tax-free growth account. Something else that we're doing is looking at discretionary expenses through the business, things like cell phone, travel, vehicles. These are business expenses that help contribute to the client's income. But by having an LLC set up and starting to track these expenses more, we're able to utilize a number of deductions. Even with their office, a business expense, the percentage of the square footage for that office can help be offset through deductions of the business, whether it be utilities, whether it be internet. There's even a thing called the Augusta rule, where when the house is used for business purposes, it might be an event, it could be a meeting, it could be rented out to the business. That also serves as a tax deduction and isn't reportable. So these are things that are important as we put together a tax and investment strategy to help this client reduce his taxable income. We're also looking at a health savings account. This is one of my favorite types of accounts. It provides a tax deduction, and then when used properly with good accounting, can be used for tax deferral, and we can invest it for a long-term investment account, and then when used properly can provide tax-free withdrawals. So it gets all three of the tax benefits: tax deduction now, tax deferred growth, and tax-free withdrawals. One of my favorite strategies to implement. The last two things that we're considering for this particular client is, number one, oil and gas investments. These often provide 70 to 90% tax deductions, and the idea is that with a $300,000 investment, we get a $240,000 tax deduction. That's assuming an 80% upfront deduction. But also we have $300,000 that now is working as a long-term investment. It is illiquid, but we do have an expectation for monthly cash payments to the investor from those oil and gas investments. And those are based off the production of the wells, but also the pricing of oil and gas. It's important to consider the individual merits of the investment, but it can be combined with a tax and an investment strategy. And then lastly, we are considering what's known as a fee simple real estate investment. This has evolved somewhat. Many of you may be familiar with conservation easements. These investments can be aggressive. There is a high level of risk. It is important for a PPM to be accompanied with a consideration for this type of investment. But our expectation is with a $50,000 investment to have a $250,000 tax deduction for this year. So as I go through and consider these multiple deductions, we look at $817,000 that would be reduced from this investor's income at a 37% marginal tax bracket. That can save $302,000 in taxes. Of course, individual circumstances will vary, but I just wanted to share with you a current case study that we're working on, some of the things that we're considering. All or some or none of these things may apply to you personally. As a tax smart wealth advisor, as an entrepreneur CFP, I look at a number of things to try to assess your taxes and your investments. I'd be happy to consider your individual circumstances and see if we have some strategies that might be helpful and that might help with your long-term taxes and investment strategy. Thank you.